Good morning, everyone. Welcome to another episode of Leverage Addicts. And today is slightly different. We're not looking at a deal as such, but looking at some of the recent changes. And there's just so many that is just coming at us. It's sometimes hard to even for us to guess what is going to happen. But there are actually four major changes. Besides the interest rate going up, there are four major changes with lending in itself, especially with the main banks. And I thought there's an opportunity for us to sort of explore what these changes look like and what it means on paper. And so you guys can actually have a look at what the difference with lending before and after. One major change is obviously the interest rate. And you guys already know that interest rate has sort of spiked up from like early this year around that 2% mark. Now it's closer to 4%. So that's major for most investors because your cash flow outgoing is going to almost double in the coming years. And with the tax deductibility being removed over time, that's going to really affect property investing in general. And I think it's really, really important for us to consider that when we're investing. I do still believe property is a very strong vehicle for investing because you got to compare it with other things that you could potentially look at, like cryptocurrency, shares. Properties provide a leverage vehicle. If you're in a good cash flow position, property is going to be still the king for many families. But in saying that, the first major change, because of interest rate going up, the servicing rate actually goes up as well. So if you guys don't know what servicing rate is, if you guys are sort of new to the group, servicing rate is when you go to borrow money at the bank and the interest rate might be 3%. They're never going to test your situation, stress test on a 3%. That is always going to be much higher. So just earlier in the year, ANZ, for example, was only doing 5.8 as a test rate. Some banks are doing just around that above six figure. Now it's gone up to ANZ itself is closer to 6.3. It could go up very soon as well, I believe. And some banks are actually testing at 7%. So that in itself, it's 0.5% difference in test rate. Now, that's not going to affect it by too much. It might be like, 100, 200,000. But the second major change, it's DTI. You guys all heard in the news, DTI. It's not implemented by all banks yet. That's the interesting thing. But DTI is sort of like, they're thinking about, having it around 7. And how that is looked at is looking at your overall income, including your rental, and the maximum you can borrow is around 7 times of that. So like, let's say, for example, we've got 100K personal income as a family, and then you've got 100K of rental income, and the rental income is usually shaded. So you can't use 100% of your rental income. It's around that 60% at the moment for most banks. Now you take that calculation, your gross income personally, and then your rental income at 60%, and then multiply it by 7. Majority of the time, that's how much you can borrow with a couple of the major banks at the moment. And exceptions could be made when these lending are in potentially like an LTC or a trust. So it's not a blanket rule, but it's more favorable if your lending is under other entities in your personal name. So just keep that in mind. And I guess in the coming months, it will sort of like play out and we can see what happens because, the banks are still, sometimes they look at it, sometimes they don't. It's just really situation dependent if there's strong enough mitigants at the moment because they're sort of like testing new rules. I wouldn't say it's a major change that's going to change your lending just yet, but it's something to watch out for. The third one that I would say that does have a really big impact is CCCFA. So CCCFA is another word, simply put, is responsible lending. I'll give you guys an example. Like, I think one of the misconceptions with lending is that, if you go into a joint borrowing, what happens is, like, let's say me and JP goes into a deal and we go, okay, I've got some income, he's got some deposit, I got some deposit. We go into this deal together thinking that we're going to be stronger because we got overall more income together. But it's actually counterintuitive with triple CFA and responsible lending, because what happens is, in the past, you could say, yep, the new lending that we're going to take is like 50-50. We only have 50% responsibility of the new lending. But in triple CFA is like the most stupid thing, kind of counterintuitive. Is if we were to take off any lending, me and JP, we each 100% liable for that. Okay, so I give an example nice and close to me. My mother-in-law, when I did her first investment property, they borrowed 700,000, and they secured that lending against their owner occupied, which was owned in a family trust that has both my father-in-law and mother-in-law. But when they took out the lending of the 700,000, the bank actually allowed us to have just the 700,000 under my mother-in-law. Okay, the borrower was just my mother-in-law. Second time around, when we bought the second property after responsible lending came, that wasn't the case anymore. I can't just have my mother-in-law as the borrower, because she wanted it nice and easy for tax purpose, since she's already doing like her filing, because she's a real estate agent. But because of triple CFA, the second time around, we had to include the father-in-law as a borrower. So like there wasn't a choice anymore for us to just have the one borrower. So that was a major change with responsible lending. But the most recent change with responsible lending, simply put, is record keeping and loan affordability. So what does that actually mean? If I was to simplify this in the most simplest form, in the past, when we do an application, what we're trying to do is do average living expense plus some major expense like your insurance, childcare, that adds donations, that adds on top of your expenses. Now, with the new rule, what they're going to look at is what is actually going out on your bank statements. All right. So we have clients where, you know, in the past, it kind of sucks, because we had a client who had approval for 850 early in the year. You know, they didn't really take action, and that's what happens with most people anyway. They don't take action. They just like think about property investing. So they got this approval for 850, and this time around we're like, okay, with the new rules, we can try 650. And when the bank picked up the application, because they see that the outgoings were much higher, like they were going out for eating and stuff like that, and the expense was around just over $1,000 difference per month, they couldn't even borrow 500,000. Yeah, you can see sort of like really quickly all of those things add up with the servicing rate, with the DTI, with the triple CFA, accounting for exactly what's going on in your bank statements. That's really going to change your lending. And then the fourth and last one that I'm going to talk about is the rental income shading, because for most of us here are property investors. Well, you're probably here for property investing. The rental income shading, some banks was using 80%, like even BNZ, like it was BNZ, the only one that was using 80%. They have come down for existing property to only account for around 60%, 65%. And that's a major change when it comes to your servicing. So I would say the safe way to look at your calculation is to actually use 60% as your test rate. So what does this all look like on paper? So I'm going to share my screen here. I know it's like a lot of frustration with clients, and I can assure you, you know, we're our team is only trying to get the clients the most lendings, and it sometimes just seems like, you know, it's our fault, but it's actually really hard. Like I know the team's quite stressed out as well, because there's just like we've never taken so many shots where, you know, maybe we're converting 90%, but now we'll take these shots, you know, we're only putting up half, right? So it's kind of frustrating, and it's just trying to like adjust as we go. So just to give you guys an example, just an example calculation here. A couple with one kid, and they got fixed expense of 1,000. This is like the insurance and childcare, 150K income, and they got 80,000 as a second income, rental income of 1,000. So pretty normal family with a property. You know, that's probably what it looks like. And then you got 1.3 mil. And so they could still borrow another 800,000 if they wanted to buy a property. And if they were to buy something around the 5% yield, if they were getting around $1,550. They could borrow another 1.6 million. Okay, so that's pretty good. Okay, and so what does it look like now with the changes? So I'm going to highlight the major changes in yellow. Okay, so first of all, we talked about the fixed expense, and some clients, you know, when we look at their bank statements, there's literally like $1,000 difference with what we propose. You know, we get the client to fill out the expense sheet, like how much you pay for each like insurance, your rates, your outgoings. But when we get the bank statements, there's $1,000 difference. So this is a major change here already. Okay, second one is your test rate. So it's better to use like an average closer to 7%, which is like 6.75. Before it was only 5.8. Okay. And then the third change we talked about was the rental income, shading to 60% of existing properties. And so this has made it harder as well. And then also the last thing is the DTI, but not a massive effect for this particular situation. But what does it look like? So before we were able to borrow closer to 800,000, but now with the new changes added to the calculation, just all these tiny things, you can see that now the borrowing goes down to 380,000. All right. And if we look at the DTI max is around 1.6 million, which doesn't affect this current situation. But as you can see, if we were to buy a 5% yield property, it's suddenly half from like that 1.6 mil mark, 1.5 mil mark to sort of 600,000, which is, it's really tough, right? This is the main bank calculation. And I think there are definitely some non-banks trying to be more creative in this space. And I think non-banks are going to be a major role for property investors moving forward. They're going to play a major role there. So it's just trying to understand, you know, like what new products are coming up. You know, last week we shared about the ResiMac one for property investors, just looking at the portfolio standalone. But yeah, look, this is some major change, and these are some of the things that we're struggling with at the moment in our back end. So if you own a home and the value has gone up, what would happen if you combine this equity that you have built up with our property formula workshop? Our clients have been using these theories and lessons, applying it in their current situation, have tremendous results. Some have become mortgage free within 7 years. Some have built a portfolio of 5 mil plus within 4 or 5 years. And some have actually generated more than $120,000 of passive income from properties. Do check out our page so you can see some of the results that our client have achieved. And this is for you if you have at least of $120,000 of equity built up in your property. This is accessible equity. And if you want to learn more about properties in general, do check out our YouTube channel, Mortgage HQ, and you'll be able to find a lot of videos about how you can invest in properties just using the equity on your home. Otherwise, I hope to see you guys in the Property Formula Workshop.